inspirational and motivational here at Clubhouse. Get a better mindset and set your goals here at Clubhouse. Educational things you need to know here at Clubhouse. Like credit, home, buying, loans, and much more here at Clubhouse. The space for education, motivation, and inspiration. Clubhouse. The space for education, motivation, and inspiration. Clubhouse.
Hey girl! Hey audience, how y'all doing? Welcome to the Home Buyers Clubhouse, where we go live every Wednesday and every Friday. On Wednesdays, we give something educational and motivational, and inspirational and motivational. And on Fridays, we give something educational. For those of you guys who don't know me, my name is Jessie Lynn, and I'm a triangle realtor with A to Z Realty. Miss Erica, introduce yourself, honey.
Hey, I am Erica Batts. I am your mortgage lender, and I'm happy to be here. Happy Friday, everybody.
Happy Friday, audience. How are y'all doing today? How are you doing on this Feel Good Friday? We're going to bring this back out, honey, because we ain't and won't and can't. Yes, honey. Yes. Anyway, look, y'all. So we are doing a recap on our credit. You know, we've been week after week, we've been talking about credit, and we've been talking about the home buying process and all of that. So we're going to put all of it together so you guys can figure it out. And then the following week, we're going to talk about budgeting and how to set up a plan to do your budgeting. And then after that, we're going on vacation. We are going on vacation because we have the holidays coming up. We have Christmas, girl. Christmas is coming up. And then we also have New Year's. So yeah, so let's talk about it. So we started it off our very, very first week. We talked about the 4 C's of credit. A lot of people don't understand, like whenever you're buying a house, the lender, they're looking at certain things. So Erica, tell them, what is character when it comes to their credit? What is character? And then we'll go into the other ones, and we're going to go through it pretty quickly. If you guys missed it, just go back and check out our video so y'all can inbox us and ask us any questions, or just drop your questions in the box below, because today is something like a Q&A session as well, because again, we're doing a recap, and anything that you didn't understand, you could ask those questions today. So what is character? So we have 4 C's of credit. We have character, we have capacity, we have capital, and we have collateral. These are the things that the lender, they're looking for whenever you go in to apply for a loan. So Erica, tell them, what is character?
Character basically is, are you going to do what you said you were going to do? Like, are you a person of your word? As far as you have borrowed money from people in the past, whether it's credit cards, whether it's car payments, any of those things, have you paid those things back on time?
Yeah. Look at their credit history, their employment history, their housing stability, to determine the likeliness that the borrower would pay their debts back. So yes, that's the definition Erica just gave you. What is the layman's terms? So capacity. So I have capacity is the lender. They may consider the following indicators to determine if a borrower will repay their stuff, like their employment history, recurring debts. Can you break that down for them as well?
So your capacity is basically how can you afford to pay this back? Like there are a lot of people who think that just because they're paying $1,500 in rent means that you can also afford $1,500 in a mortgage payment. But because there are different criteria that you look at for rent versus mortgage, that may not be the case. So we're only willing to lend you the amount that we feel like you can pay back based on your numbers.
So you try to tell me that I can afford $1,500 in rent, but I can't afford $1,100 car mortgage?
That's correct. So, with mortgages, you can only use a certain percentage of your income in order to be able to use that to go towards any credit reporting bills. So they're looking at things like that $700 car payment that you have. We're factoring that in. as far as what, how much you can afford to pay. We factor that in. Whereas rent, they only want you to make 3 times the rent. So they don't care what your other bills are. Do you make 3 times the rent? So that's their only concern. Whereas ours is, we want this to be affordable long term for you. So that was part of the whole 2008 housing collapse. That was something that was in place. And this is something that was instituted after that, just to make sure that if we loan you money for this house, that it is an affordable purchase for you.
So push pause and rewind. So you said that it depends on a certain percentage. Does it varies with the type of loan that I get? Because there are different types of loans out there, right?
It does. So there are some loans where your maximum debt to income ratio is 36%. There's some where it's 43%. There's some where they can go up to 50%. There's some that don't have a maximum DTI. So it just depends on the type of loan that you have. And then a lot of times, I will also say this, is a lot of people coming in saying, well, I want an FHA loan. But that's because that's the only loan that they've heard about. That's not because that's the best loan for them. So when you work with me, then this is a conversation that we'll have based on your circumstances, and we can figure out the best loan product for you.
Okay, so let's talk about that also. I know we talk about the same stuff week after week a lot of the times, but a lot of people don't understand. So explain to them what's an FHA loan and the different types of loans. So you have FHA, you have a VA loan, you have a conventional loan, you have a loan, you have a personal loan, you have all these kinds of loans out there. What are these loans?
So those are usually backed by some of the different lenders. Some of the different government entities. So there's a few different ones that will back mortgages. So you can do an FHA, which basically means that you're going to put 3.5% down, and then as the lender, then I'll give you the other 96.5%. There are other things like your conventional financing. Conventional financing can range anywhere from 3 to 20%. It depends on what type of loan that you're looking for. Would depend on what that looks like for you. Your USDA is usually a 0% down, but you have to meet other criteria. And the VA is usually a 0% down. But again, you have to meet the qualifications for VA loan.
So does the credit score varies in all of these loans?
Yes. So there's different sets of criteria to go with each loan type.
Okay, awesome. So the next thing that they're looking at also whenever they're checking your credit, and we're talking about a lender for those of you guys that's just tuning in. So when they're checking your credit, they're also checking for something that's called capital. What is capital? We hear that word a lot. Capital, capital, capital. What is capital?
How much money do you have to go towards or your assets or those type of things? Because certain loan types, you also have to have reserves. So not only do you have to be able to afford the house payment plus your other bills, you also have to have a certain amount in reserves. So that means if, with some people, you have to have 2 months of reserve. So that means I have to have an additional 2 months worth of payments in savings, 401k, life insurance, something else, so that I know that in the event something happens, you're not then saying, okay, well, I can't afford to make the repairs on this house. Or if you get a hurricane comes, blows part of your roof off, you have to pay the deductible, and you're like, but I don't have $1,000 to pay. So those are the things you want to look at, because there are other expenses involved in a house other than a payment.
Yes. But okay. So now that you've said that, for the people out there, the renters that's currently out there, they don't want to buy a house because they don't want to have to take care of the house. What would you tell them?
My theory on that is the same phone call you make to the office is the same phone call you're going to make to your insurance company, or the same phone call you're going to make to, the repair place. So it's still repairs either way. And I will say home ownership is not for everybody. I personally feel like it should be, but just because of the wealth aspect that goes with it. But there's some people that don't want that. And if that's you, then that's okay. But just for those that do, we want to make sure that you're fully prepared. So that's why we have like the Home Buyers Clubhouse. So we can talk about, okay, well, you also have to make sure you have enough to power wash your house every 3 years or whatever it is, the additional maintenance.
So we're going way off topic, but since you said that, and you did say that home ownership is not for everyone, but it's so sad. Like when these families, they pass away, the mother passes away,
Mhm.
and then their families have nowhere to stay. I'm getting a tear in my eye, but I remember when I was in property management or whatever, the mother, she was the only one that was actually on the lease. Her grandson was living there. He wasn't supposed to be there. But she passed away. I didn't know she passed away. Right before she passed away, she stopped by the office and she done her recertifications or whatever. She was going into the hospital to have a procedure done or whatever. I did not know that she passed away shortly after that. Had no idea. But I noticed it was a lot going on, a lot of traffic going on going on at the house because her apartment was like right in front of my office, and I'm just like, I haven't seen her in a while. Something said, look up her obituary. I looked her up. She had passed away right after she recertified, and then the unfortunate part. I mean, if her son would have came over there, we probably could have fixed some stuff so he can,
Mhm.
but he just moved. I sent the letter out and he just left or whatever. But it's sad. It's really sad. So that's why home ownership is important, because can't nobody kick you out of your mother's house if she passed away.
If your
You
mama
don't
owned
have a
the
lease
not if your mama owned the house.
if she owned the house. If she owned the house or whatever, she got a mortgage. Can't nobody kick you out. You paying that mortgage. You paying that mortgage. You got laws and different things in place or whatever. So yeah.
Well,
So
and then
yeah,
it
just
helps. It also helps, like we always talk about, build wealth, things like that. I know a family where this one family lived in this house for 43 years. So the grandmother
mhm.
lived there. Then once she passed, the mom lived there. Once she passed, then the daughter lived there. But they were renting the entire time.
See, that's so
So
sad.
43 years worth of rent in one family. And just imagine if, like, especially back when the grandma first, got into housing, had she
Mhm.
purchased that house back then, you know, rent is most of the time our biggest bill, or housing. And so can you just imagine how much money they could have either saved by not having to make those mortgage payments because it's
Mhm.
already paid for?
Yeah, and that was my next statement was like whether you decide that like you said, renting is not for everyone or whatever, but if you decide, just think about your children in the end. Like if I leave, where will my kids go? Can I leave anything for my family? So like you said, it's about building generational wealth, but think about your family. You don't want to deal with the responsibility right now, but just think about your family in the end. But again, it may not be for you, and it's not something that we're trying to sell, but we've seen and heard so many sad stories, or people rent is increasing by 3, 4, 5, $600. These people can't afford that, especially if they're living from paycheck to paycheck. The one thing you don't have to worry about your mortgage doing is, well, depending on the type of mortgage that you have, but you don't have to worry about it doing that in a year. You
And
don't.
I will say the other thing is, I know a lot of times we focus on people with children or something like that, but even for an individual, um, if somebody came to you and said, "Hey, I can tell you that 30 years from now, you're going to be paying, $150 more for mortgage or for your payment than you're paying right now." So sometimes it's just that security. And then, if you live in a place for 30, 40 years and that place is paid for, so now when you get to go on Social Security or whatever, you don't have to take a chunk of that to go towards your more towards a mortgage payment because your house is paid for. So the only thing you're paying for is your taxes and your insurance, which is,
Exactly.
most of the time a lot less. And so if you can just secure your own future by saying, "Hey, I just want a stable payment for the next 30 years."
And that's a good thing about us, all of us here in the clubhouse, because we are all in different situations in our life.
Mhm.
Some of us have kids, some of us are married, some of us are not married, some of us are separated, some of us are divorced. You have different things going on. So that's like we can all relate, and we've seen different sides of it. So we've been there, and that's why a lot of people, they are afraid to go out and get help or ask for help, or ask a question because they don't want to seem embarrassed, or they are afraid that someone is going to judge them. But just know, we've all been there, and we probably had a client that has been in the same exact situation that you've
Mhm.
been. And one thing about me as your real estate agent is everything you tell me is pretty much confidential, unless you're telling me something about your house or some other stuff, and I'm going to read you your Miranda rights before we list that house. But all I'm saying is, anything else is confidential between us. So don't be afraid to sit down and talk and open up and be honest with me, your real estate agent, with your lender, your loan officer, because we've seen it all, and we cannot help you if you don't sit down and have that transparent conversation with us. Period.
Yeah. So, and I've helped somebody where a lady was almost 90 years old, and she was buying her first house. And so, don't feel like you're too old. Don't feel like that you're like, oh, well, I never thought that I could. It's like, okay, let's have a conversation about it. It doesn't cost you anything to have the conversation.
Right.
It's, if we can help get you on the right track, or maybe, guide you and say, hey, okay, well, instead of doing this, try this. And I think that'll help you reach your goal.
Yes. See, look, y'all. And I know for those of you guys that's watching, y'all probably like, okay, we're supposed to be talking about credit and home ownership. But sometimes we have to get like this, because a lot of the times we do this week after week after week. And sometimes we forget. We got to break stuff down, and we have to tell stories. We have to give real life stories, because so many times we have a plan and we just kind of going through it. And this is why I thought today would be a good idea to do the recap, because we've already talked about this. But we hope, our job here is, and we always hope that we can reach that one person, or we are speaking to that one person, to that one situation. We don't have to speak to thousands, but we hope to just reach at least one person, and hope that they hear us and understand where we're coming from. All right, the next C is collateral. Erica, what is collateral?
It's things like, what do you have to put down as far as your down payment, things like that. Like we talked about, you got to have your reserves. You have to have all of those things.
Okay. So let's put all these 4 C's together. So we talked about the 4 C's of credit. We have your character, capacity, capital, and collateral. So someone coming into your office and they are meeting with you, some ways for them to prepare. What should they do to prepare to meet with the lender whenever they come in?
Generally just have your paperwork, because it's not, and the actual application piece of it is like a 5-minute deal. It's not very much, but it's being prepared. So you want to have your bank statements, 2 months of your bank statements. You want to have your 30 days worth of paycheck stubs. You want to know about your current your current housing situation. How much are you paying now? If you have a house that you have to sell, then bring your current mortgage statement, those type of things, so we can talk about what that looks like for you. Do you want to sell that house? Do you want to keep that house and buy another house? There's a lot of different scenarios, and then the rest of it is just a basic conversation about what's going to work for you.
Okay. All right, so that's that. So you know what to bring, and you kind of know how to prepare with your meeting with the lender as well. So that was another thing we talked about. So as far as your credit, when they are looking at your credit, they're gonna determine 5 things on that credit, and not just us. It's just your credit score. Period. Is based off of these 5 factors. Okay. So number 1 is your payment history. Your payment history. Are you paying your bills on time? So that makes up about 35% of your credit score. So just make sure you're paying your bills on time. Number 2 is your credit usage. So you have a $500 credit card and you've used $499 of that $500 credit limit. So that is going to automatically drive down your credit score. Your credit usage should be less than about 30%. Your goal when buying a house is about 10%. So if you have a $500 credit limit, you don't want to spend no more than $50 on that. So a lot of people, they always feel like that they have bad credit, but they don't have bad credit many times. They can't figure it out. If you're one of those people that's paying your bills on time, you have some stuff on your credit or whatever, not stuff on your credit, not bad stuff, but you have credit or whatever, and your score is low, the first thing you want to check is your credit cards, your utilization rate. Check that and start paying those down. Don't pay them off. Don't close them. You can pay them off, but don't close them or whatever, because your age is one thing that plays a factor as well. Okay?
I do just want to go back to the first point that you said when you were
Okay.
talking about the how you pay your bills. I also want people to realize is just because you had some hiccups in the past with how you
Amen.
paid your bills, that is not a forever kind of thing. So just because you had an issue 5 years ago does not mean that that is still your same issue today. Let's talk about it and have a conversation.
Amen. All right. So 1, 2, payment history, credit usage. The next thing is your credit mix. Do you have all credit cards on your account? Do you have all installments? Do you only have a car payment? So your credit mix, what do you have different things on there like a credit card? Do you have installment accounts? Different types of credit. That's the next thing. The next thing is, like I said earlier, is the age of your accounts. Do not go close these accounts. Don't close your accounts, especially while you are trying to build your credit score. The age of these credit cards on your account, and please, I've seen this in groups. Oh, I paid down my card. Should I close it? Do not close these cards. Do not close these cards. Do not close these accounts. Please do not. Because once you start paying this stuff off and you start closing these things, your score is gonna drop. Ask Erica. Erica, am I telling the truth, honey?
Yeah, you are telling the truth. And I will tell you, credit scores are kind of a there's some things that's kind of mystical about it, like because you're like, okay, well, why would if I paid it off, why would my score drop? And usually it will pick back up, usually within about 2 to 3 months. But it's just the utilization, like how much credit do you have available to spend? So if they're not reporting anything, then they're like, okay, well, we don't know what's going on with this. Same thing if you pay off a car. I had a client recently paid off their car and their score dropped like 14 points. But even though it was just a temporary drop, but it did drop 14 points. So don't get all caught up in your Credit Karma scores that they give you every week and say, hey, this is your score. Oh, it dropped 15 points. Because when you look at FICO, which is what the lenders use to lend money, the scores are not the same. And it doesn't drop usually that drastically within that same time span because they're not checking every day.
And the last thing on there is your credit applications. Don't go out applying for a lot of credit cards and different things at one time, because the lenders are going to scratch their head and say, they broke? Are they broke? Mm-hmm. Why? They want you to have credit. They want you to have good credit, but they don't want to see you out there talking to everybody about credit. You know what I'm saying? They don't want you to go open all these accounts because they're wondering like, okay, will she be able to pay us back? Like, what's going on here? Mm-hmm. So it causes your score to drop. It's only about 1 or 2 points, but still, you need all those points. That's why it's at the bottom. It's the very last one.
It's usually an indicator of, they use that as an indicator of, okay, they may be in some financial trouble. Like the other thing that I found was the energy company had reported, like from an old address, they never sent me my last bill. So when it went to collections, and when it popped up on my credit report, because they never sent me anything to say, hey, you got a bill here. And like my score dropped like 25 points. And I'm like, wait a minute, what's happening here? Right. And because that's an indicator of, okay, if they starting to get some utility bills, this is a sign of trouble. And, even though I was able to clear it up and it was fine after that, but still that drastic 25 points, I was clutching my pearls like, oh, wait, I will be the mortgage person. And then my credit dropping, like, this is not good.
Right. But how did you know your credit score dropped by 25 points, Erica?
Actually, because I did use a Credit Karma, that kind of thing. So Credit Karma is great to monitor your credit. It's just not great for the actual credit score because, like I said, they never notified me. It's the same thing a lot of times with medical bills. People will see that medical bills will pop up on their credit report. And they're like,
Okay.
well, nobody ever told me, things like that. So it's good to monitor.
Tell them how to monitor their credit score again.
So, like I said, you can use like a Credit Karma, things like that to monitor your credit report to see what's on there, that type of thing. But your actual credit score, if you want your own copy of your credit report, you can do that at annualcreditreport.com.
There you go, y'all. So, and that's a good way to keep up with the things that's on there. We talked about how to dispute these items on your credit report, and this is one way to monitor what's going on. If something's added, if you have fraud or anything like that, use them and keep an eye on it. Check your credit on the regular. I said at least once a month. I'm sorry.
Well, and I will say I agree. And then if you have kids or elderly people in your life, check theirs as well, because those are the ones where, they're issuing social security numbers, all of those kind of things where they're getting a hold of kids social, all of these things. And then it's now your kid is 12, 14 years old. And it's like, wait a minute, they had $50,000 worth of debt back in their name back in such and such a time.
Right. And before we wrap it up, y'all, again, we talk about disputing your credit score a lot, and we always talk about building. One of the quickest ways to build your credit score is, first of all, you need to make sure you're paying your bills on time. But number two is just make sure that you can add new credit. Erica said that earlier about your utilization rate. So let's say if you have multiple cards, a $500 card here, $500 card here, $5,000 card here, different things like that. It can help build, and it's also going to show them that you're able to make your payments on time. So you build your credit by adding credit, but you got to make those payments on time, and you got to keep your balances low. Don't get a new card and max it out. And one way to build your credit is to get a secured credit card. What a secured credit card is just basically a card that you give them some money, and then you use it as if it's a real credit card, and you make those payments every month on time, and you keep the balance low. You got anything you want to add to that?
Let's see. I will tell you, I usually recommend Self as a credit card, and it's one that kind of works like that.
Oh, you gonna freeze when you start telling us some good stuff, girl? I bet you the audience is like, what in the world is going on? She just froze on us, y'all. There you go. You back, girl. Tell them what now?
It's called Self, and it is a card which allows you to buy a CD kind of over time. And then at the end of that time, you're able to get most of your money back, but you were able to build credit throughout that time frame.
Awesome. And look, y'all, if y'all want to get a house, you can go to Landis. If you want to do like rent to own, Landis, they are doing rent to own as well. If you're not in a position where you can get a mortgage, but who knows if you are in a position to get a mortgage or not. Nobody better than Erica, a lender. So you need to contact them if you're thinking about getting a house in 2023, because Erica can help you come up with a plan to get you there, even if you're not there. But who knows, you may be there. I've seen many people think that their credit sucks and they end up getting approved like that. So you never know. Right, Erica?
That's correct. It's like I said, it's a conversation.
Yes. All right, y'all. So I hope we got everything. But look, for these letters, if you missed it last week, you can go to www.hcrjournal.com to get the letters, to get the book. We have free letters on there. We have a free home buying checklist on there. And we also have a free journal on there as well. So start disputing your credit today. Pull your credit report tonight. Start disputing it. Start building your credit score. And let's get you in our home in 2023. Next week, we're going to talk about budgeting, because we know you need money to buy your house. I don't care if it's zero down or not. You need money to buy your house. And we're going to talk about budgeting, saving, and just building and growing and sowing in 2023. Anything, Erica, before we go?
No, that is it.
All right, y'all. Oh, look. And if y'all want our book, it's not too late. You can get our book, the Home and Credit Journal Recipe, Home and Credit Recipe Plus Journal. Y'all can get that at hcrjournal.com as well. If y'all have any questions, feel free to inbox us or contact us today. We hope you guys have an awesome weekend. For those of you guys who don't know me, my name is Jessie Lynn. I am a Triangle Realtor with A to Z Realty. You can reach me at 919-818-9854. Miss Erica.
Hey, and I'm Erica Batts. I am your...
She went out, but her name is Erica Batts, and she's our mortgage lender. You can reach her at 919-608-7916. You can reach all of us at the clubhouse at www.thehomebuyersclubhouse.com. And you can find us on Facebook in our private group and on our page at Home Buyers Clubhouse. And you can find us on YouTube at The Home Buyers Clubhouse. We hope you guys have an awesome day. We'll talk to you guys soon. Bye-bye.